Stephanie, given the uncertain macro environment that we're operating in right now, how are dividends playing a role in your investment strategy?
Well, we've been adding dividends for the last couple of years, especially as the yield has been so low. So it's not that hard to find companies that are yielding 3–4%. Those companies that also have some growth to the dividends too, to me, is also important. So not just the actual number itself, but whether they have the capacity to increase it and grow it over time.
So would you recommend looking for something with that 3 to 4% dividend yield to, kind of make up for inflation?
Certainly. I mean, that kind of is the minimum that, you get excited about. But again, if you have some companies that are only yielding, 2–2.5%, but you see growing over time, I think that is actually where there's more excitement. And maybe they're less kind of crowded, if you will. Maybe people are really looking for the 4, 5, 6% kind of numbers. And, we have a combination of a lot of them in the fund.
Clerk is one that you've been adding to recently. It has a yield of 3.7%.
Yeah.
What else is attractive about that name?
Well, we like their kind of best in brands. We also like the restructuring program that they've been doing in terms of cutting lean costs. And also, 70% of their revenues are tied to the U.S. So we have been really trying to focus more of the names that we own with exposure in the U.S. We've been doing that for quite a while, right? That doesn't mean that all of the names are just U.S.-centric. You do want to have some upside down the road because, A, everyone is so down and out about the global economies and about China and about Europe. It might give you the opportunity in terms of where some of the stocks have gotten beaten up. So, but for now, that's the one that we're playing in terms of the U.S. kind of boring name.
Well, JP Morgan, you mentioned stocks have gotten beaten up and their yields are looking more attractive now. JP Morgan's one. What's your thoughts on that? I
mean, it's down now 5% on the year. It was actually, it was up 30%, in the middle of March. So it has, corrected huge. The Jamie Dimon premium is out. It's trading below tangible book. It's got a great balance sheet, though. I mean, they're going to earn $20 billion this year. So I think the $2 billion in trading losses, and obviously it's going to be more than that. I think that it's kind of overdone. I think sentiment is really negative, and it is really a best in breed for the long term. So we had to start picking at it. Either that or we were gonna punt it, and I just kind of feel like the value is really there.
And is this one that they could increase the dividend, even though I think they took the repurchase away?
Yeah, well, they took the repurchase away, but they are committed to the dividend, and they certainly can, and I expect them to increase the dividend in the second half of the year if they can get kind of more of the controls over this loss. So, I think, again, it's trading at $31. I think their downside is like 28, and I think your upside is like 35, 36, and so I like that risk reward. Again, I just think it's definitely overdone to the downside.
This market is
stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to